ンライン証券。
Hello again, I'm Pearlie Yap, the lead portfolio manager for the Asia-Oceania High Dividend Equity Mother Fund. As many of you know, the fund has been around since 2005 and remains a flagship offering of Asia-Pacific ex-Japan equities for investors in Japan. I have been working on this strategy since I joined eSpring in 2011. The third quarter of the year has been a volatile period for markets. Sentiment was buoyed by the relaxed tone of Chairman Powell at the Jackson Hole and a moderation in inflation data, despite the surge in coronavirus cases related to the Delta variant, which actually affected markets very little. Against this, there was the regulatory noise in China, especially in the e-commerce and education sectors, that evoked concerns. The common prosperity tenets set forth by the Chinese Communist Party are also coming on the back of regulatory reforms in the internet sector. I will explain what we think common prosperity is and is not in the following slides. We understand the markets in China and, looking through today's volatility, still see opportunities. Let's think of China as moving through the 3 R's: regulation, restructuring, and resiliency. After the spate of regulation and restructuring, we believe that China will have a firmer foundation in its economic and societal structures and emerge as a more resilient society. Our outlook for 2022 remains broadly optimistic, with vaccines and reopening propelling a cyclical rebound in areas of the market that have been left behind and areas that have become oversold, particularly in China, as fears have bubbled to the extreme. Next, I would like to share with you the regulatory crackdown in China that has been escalating of late on the back of the common prosperity principle. But let me break this down more simply. I want to stress that there will be no common prosperity without prosperity in itself. It doesn't mean that getting rich is frowned upon, the seizing of private assets, or discouraging wealth creation through legal means. It means that private companies have to abide by new regulations that are anti-monopoly and respect privacy and labor laws. Ultimately, the legitimacy of the party is won through the uplift of the masses, and that can only be achieved with China's economic progress, with strong foundations in innovation and with fair business practices. China still targets a doubling of GDP over 10 years. The same conversations are taking place in developed markets on regulation. China, being on a very top-down and centrally planned, executes much faster than other countries. China has the largest digital economy in the world at 40% of GDP in 2020. And the aim of the current regulatory cycle is not to destroy this, but to promote quality and sustainable economic growth. Our portfolio is positioned in select internet companies that have fundamental support on valuations and strong business drivers that can lead to better earnings outcomes, even in the face of higher regulation. Not only do Tencent and Alibaba have large market shares, they also have competitive and diversified product offerings, a talent management, broad brand recognition, and are deeply integrated into important aspects of online work, online shopping, online education, and online medical services. Next, I would like to share with you the developments of the real estate sector in China. There is an aim to restructure the economy to be less reliant on fixed asset investments, have healthier leverage levels, and a cleaner environment. We see regulation towards lowering the carbon intensity of heavy industries like steel and aluminium, and local governments putting caps on carbon emissions. At the same time, China feels that there could be risks lurking in the leverage of the large property industry and has set out plans to control it. They have been very successful in controlling runaway property prices. But of late, after a strong first half 21, felt that it was also timely to put further brakes on mortgage dispensation. The Evergrande saga is posing a confidence risk, and given that property accounts for 70 to 80% of household wealth in China, any significant decline in housing prices will trigger a cascading impact on the economy and markets. We believe the government's ultimate goal is to decelerate the pace of housing price growth, but not to make it decline or go into the negative zone. The Chinese government has knowingly engineered the cooling of the property sector to upkeep the financial system's stability and are fully prepared to handle arising challenges. Besides, the current property market situation is not as bad as it was in 2014, when the industry was faced with oversupply for the first time in its history. Property inventory levels are relatively low and supported by continuing sales and a controlled pace of new launch releases by developers. Now, valuation is a key reason to remain invested in the China real estate sector. And as the sector is trading at all-time low valuations, returns will usually be generated when the maximum market fears are mitigated, especially since our investment horizon is longer than most market participants, and as we think that the sector will rebound sharply on any regulatory loosening. We are sticking with high-quality developers with a sound balance sheet and capabilities to consolidate the market as the weaker players exit. Weaker players will not be able to meet the 3 red line policy of the Chinese government that requires developers to decrease borrowings on their balance sheets. China has long-term challenges of an aging society and is still relatively low in GDP per capita, so it cannot thrive by looking inwards. In eSpring, we continue to look for opportunities to invest in strong companies that are misunderstood and sold down in the market turmoil. Moving on beyond China, let me talk about the tech sector, where we hold a strong belief in our structural growth trends. There are multiple drivers of semiconductor and chip demand, driven by 5G, artificial intelligence, advanced driving assistance systems, electric vehicles, and the Internet of Things. Sales of semiconductor chips is expected to grow at a compounded average growth rate of 10.7% per annum over 2020 to 2023, almost double its CAGR of 5.5% in the periods 2015 to 2020. Sales of 5G phones and investments in 5G infrastructure should also accelerate. Globally, the total investments in 5G infrastructure is expected to reach $350 billion, 30% more than the total investment in 4G infrastructure. In addition, the value of semiconductors in each vehicle will increase from $170 to $1,200. As a result of the rising popularity of EVs, the EV-related sector of the automotive semiconductor market is expected to enjoy a compounded annual growth rate of 20% from 2020 to 25. Another driver of the semiconductor sector is the gaming sector, where demand for high-performing chips has been rising as 5G cloud and virtual reality lifts innovation and create more immersive games. We see the tech sector going through a structural shift of higher digital intensity, and thus we are comfortable with valuations and prospects. This is also a sector where we continue to harness very high dividend yields. And to wrap up, let me remind you of our approach in the fund. We have a skilled and professional team that are strong stock pickers and will look for the best opportunities for you. You can trust us to engage companies to ensure that they allocate capital to the best investments to deliver long-term sustainable returns and in turn higher dividend payments. We also ensure that our companies strive to protect the environment, do good socially, and support shareholder interests. We are as excited as ever about the opportunities of the fund, and we think Asia has entered the golden age of technology innovation. So thank you for your time today and for taking an interest in the fund. We hope to be able to update you in the future with more interesting stories and positive performance.